Iran just turned the Strait of Hormuz into a $2 million toll road. The taco trade, market whiplash, and what happens to oil now. Iran didn't reopen the Strait of Hormuz. It didn't get bombed either. Instead, it did something nobody on Wall Street predicted. It turned the world's most important oil shipping lane into a $2 million toll road. On Monday, President Trump said U.S. and Iranian talks had been productive and halted planned strikes on Iranian power plants. The Dow jumped 631 points. Brent crude fell nearly 11%. Markets exhaled. By Tuesday, the relief was already fading, because while Trump was announcing de-escalation, Iran was quietly charging ships up to $2 million per voyage just to transit the Strait of Hormuz. Bloomberg confirmed the payments are real. An Iranian lawmaker called it a new sovereign regime, and Iran is already floating the idea of making it permanent as part of a post-war settlement. Wall Street has a name for Monday's rally. They are calling it the taco trade. Trump always chickens out. It is not a compliment. In this video, I am going to break down exactly what Iran's toll means for the global energy order, why Monday's stock market rally may have been built on a foundation that is already cracking, why India, Saudi Arabia, and the UAE are furious about this toll under international law, and what all of this means for oil prices and your portfolio going forward. Because the story that seemed to be ending on Monday is far from over. The $2 million toll, what Iran actually did when the ultimatum expired. Let me start with the detail that changes the entire narrative of this conflict. When Trump's 48-hour ultimatum expired Monday night, most of the world expected one of two outcomes. Either Iran backs down and reopens the strait, or the U.S. strikes Iranian power plants. Neither happened cleanly. Instead, Iran executed what analysts are now calling its third option, and it is strategically far more sophisticated than the binary the market was pricing. Iran began charging select commercial vessels up to $2 million per voyage to transit the Strait of Hormuz. The payments are happening on an ad hoc, case-by-case basis. Bloomberg confirmed that some vessels have already made the payment, though the currency being used is not yet clear. The mechanism is informal, but the intent is not. Iranian lawmaker Alaeddin Borujerdi, a member of the parliament's National Security Committee, announced this publicly on state television. He described it as a new sovereign regime in the strait after many decades. His exact framing, collecting $2 million as transit fees, reflects Iran's strength. War, he said, has costs. What Iran is doing is modeling itself on the Houthi Red Sea playbook, but at a strategically more important choke point. The Houthis disrupted Red Sea shipping by forcing vessels to request permission and pay effective protection fees. Iran is doing exactly the same thing at a corridor that handles 20% of the world's daily oil and gas supply. The difference in scale is enormous. Here is the detail that makes this particularly alarming for the long-term energy order. Iran has not just floated the idea of an informal toll. According to Bloomberg sources, the Islamic Republic is already discussing formalizing these charges as part of a broader post-war settlement. One source said this could become a permanent fixture, effectively turning Iran into the gatekeeper and toll collector of the world's most critical energy artery. For context on what that means in practice, if every tanker passing through Hormuz paid a $2 million fee and we assume even a fraction of the normal 100-plus daily transits resumed, we are talking about revenues in the hundreds of millions of dollars per week flowing directly to Tehran. This is not just a tactical move. If formalized, it reshapes the geopolitical economy of the entire Middle East, and at least 9 Chinese tankers linked to state-owned COSCO are currently waiting north of Abu Dhabi, apparently queuing for authorized transit. The selective reopening is already happening. Iran is already acting as the gatekeeper. The question is whether the rest of the world accepts it. The taco trade. Why Monday's rally may have been a false signal. Now let me explain Monday's extraordinary market move and why traders are already questioning it. On Saturday and Sunday, markets were primed for another brutal week. Asian markets had fallen 3 to 6% on Monday morning before Trump's post changed everything. At approximately midday Monday, Trump posted on Truth Social that U.S. and Iranian talks had been productive and that he was halting strikes on Iranian power plants and energy infrastructure. The market reaction was immediate and massive. The Dow closed up 631 points. The S&P 500 gained 1.15%. The Nasdaq was up 1.38%. Brent crude fell nearly 11%. Its biggest single-day drop since the war began. Small-cap stocks, which had fallen hardest, led the recovery rally. All 11 sectors of the S&P 500 finished positive. Volume was the highest in 20 trading sessions. And then Iran's foreign ministry stepped in. Tehran denied that any formal talks had taken place. Iran's state media said Trump's characterization of the discussions was an attempt to, and I am paraphrasing here, manipulate public perception. This is where Wall Street's taco trade terminology entered the conversation. Taco, Trump always chickens out, is a term that has been circulating among traders since earlier in Trump's presidency to describe a pattern. The president issues a maximalist threat. Markets panic, then Trump announces a de-escalation or deal, markets rally, and the underlying problem either persists or quietly worsens. The Chevron CEO delivered the market's reality check. Speaking at S&P Global's CERAWeek conference in Houston on Monday, the same day as the rally, Chief Executive Mike Wirth said he does not think the supply disruption from the Strait of Hormuz closure is fully priced into oil futures. The market, he said, is trading on scant information and perception. The physical supply of oil reaching end markets, he noted, is smaller than futures contracts suggest. And by Tuesday morning, his warning was playing out. Brent crude was climbing back above $103. The S&P 500 was trimming Monday's gains. The toll news from Bloomberg was spreading across trading desks, and the market was realizing what Iran had actually done. Not reopened the strait, but monetized its control of it. The honest assessment, Monday's rally was real in terms of price movement. Whether it was real in terms of fundamental change is a different question entirely. Why India, Saudi Arabia, and the UAE are furious, and what international law actually says. The geopolitical reaction to Iran's toll has been swift, and the countries pushing back hardest are not the ones you might expect from the headline framing of this as a US-Iran conflict. India's response was the most direct. Prime Minister Narendra Modi said publicly that international laws guarantee the right of freedom of navigation through the Strait of Hormuz, and that, and I am quoting his social media post here, no one can levy any fee for use of the channel. He added that ensuring the strait remains open, secure, and accessible is essential for the whole world. Modi raised this directly with President Trump on a phone call Tuesday. India's concern is not abstract. 4 Indian-flagged vessels carrying liquefied petroleum gas were among the first to transit the strait under the new Iranian conditions. India got those ships through, but paying a toll, even informally, sets a precedent that New Delhi considers legally and diplomatically unacceptable. Saudi Arabia and the UAE have an even more direct stake. These countries depend on the Strait of Hormuz to export their own oil to the world. Saudi Arabia has been rerouting some crude through its east-west pipeline to bypass Hormuz. But that pipeline has a fraction of the capacity of the strait itself. A permanent Iranian toll on Hormuz would mean Saudi Aramco, and by extension every consumer of Gulf oil, paying a tax to Iran simply to sell oil that has nothing to do with the conflict. For the Gulf Arab states, the toll raises 3 interlocking concerns: sovereignty, the strait runs through international waters, and under the UN Convention on the Law of the Sea, innocent passage is guaranteed without fee. Precedent, accepting even an informal toll sets a template that Iran and potentially other actors could weaponize in future conflicts. And the potential for permanent control, if Iran formalizes this arrangement as part of a post-war settlement, It achieves a strategic objective it has sought for decades: recognized authority over the world's most important energy corridor. The international law position is clear in principle. Under the United Nations Convention on the Law of the Sea, UNCLOS, ships of all nations enjoy the right of transit passage through straits used for international navigation. This right cannot be suspended and no toll can be levied. Iran has historically not ratified UNCLOS in its current form, which creates a legal gray area that Tehran is clearly prepared to exploit. The practical question is enforcement. Who forces Iran to comply? The U.S. Navy has already begun operations to escort some vessels, but the scale of the strait's normal traffic makes comprehensive naval escort economically and logistically unsustainable at any extended duration. What this means for oil prices, shipping costs, and investors. Going forward. Let me bring this back to the investment implications, because the toll changes the medium-term oil price picture in a way that Monday's rally did not account for. Here is the core issue. Before the war, the cost of shipping 1 barrel of oil from the Persian Gulf to Asia was approximately $2 to $3. Add insurance, port fees, and logistics, and the total landed cost was well understood and relatively stable. The $2 million toll, divided across a typical large crude tanker cargo of around 2 million barrels, adds approximately $1 per barrel to the cost of every shipment. That sounds modest, but multiply it across all Gulf oil exports and the effect is permanent inflationary pressure on energy costs, baked in regardless of whether the wider conflict resolves. Add that to the insurance premiums that have already surged to multi-year highs since the war began, and the total cost of moving Gulf oil to market has risen sharply even before the oil price itself is factored in. Joe Davis, Vanguard's global chief economist, laid out the danger threshold clearly on Tuesday. He said the biggest wildcard is the price of oil. His concern level rises sharply if oil breaches $150 a barrel and stays there. At that level, he said, the consequences are markedly weaker economic activity, much higher inflation, and a Federal Reserve in an even trickier position than it already is. $150 is not the current baseline, but it is no longer an unthinkable number either. The U.S. Energy Secretary Chris Wright struck a more optimistic tone at CERAWeek, saying the White House aims to bring more diesel to market to combat surging fuel prices and that Asian countries are increasing their intake of U.S. liquefied natural gas as a substitute for Gulf supply. The IEA's coordinated release of 400 million barrels from strategic petroleum reserves is also providing some relief at the margin. For investors, the sector picture remains unchanged in direction, but the timeline has lengthened. Energy stocks remain the only consistent outperformer in this environment. But the smart money is now modeling a scenario where the strait does not fully normalize for months rather than weeks, and where Iran's toll, formal or informal, becomes a permanent feature of global energy economics. The beaten-down sectors, technology, consumer discretionary, real estate, remain the recovery plays if a genuine de-escalation materializes. But the TACO trade experience on Monday is a reminder that Trump announcements do not automatically equal structural resolution. Until tanker traffic through the strait approaches something close to its pre-war levels, and until the toll question is legally resolved, the global energy market is operating under a fundamentally different cost structure than it was a month ago. 3 things to watch in the coming days. First, whether the toll becomes formalized or remains ad hoc. Formalization is a significant escalation even if it sounds administrative. Second, whether Modi's call with Trump produces any concrete diplomatic framework for Hormuz transit rights. Third, the U.S. weekly crude inventory report, which will give the first clear data signal on how much the physical supply disruption is actually feeding through into U.S. stockpiles. Let me pull this together. Iran's response to Trump's 48-hour ultimatum was not capitulation and not escalation in the military sense. It was monetization. Tehran has begun charging ships up to $2 million per voyage to transit the Strait of Hormuz, effectively turning the world's most critical oil corridor into a toll road and establishing what Iranian officials are calling a new sovereign regime over the waterway. Monday's enormous market rally, Dow up 631 points, Brent crude down 11%, was driven by Trump's announcement of productive talks. By Tuesday, markets were giving back gains as the toll news spread and Iran's foreign ministry denied formal negotiations had taken place. Wall Street has named this the taco trade. India, Saudi Arabia, and the UAE have all stated that the toll is unacceptable under international law. But enforcement in practice is a different matter. If formalized, this toll reshapes the economics of Gulf oil exports permanently. Vanguard's chief economist warned that oil above $150 would produce markedly weaker economic growth and an inflation shock the Fed cannot manage without raising rates. That is not the base case, but the gap between here and there is narrowing. The story that seemed to be ending on Monday is not ending. It is changing shape. If this analysis helped you understand what is really happening with Iran, oil and markets right now, beyond the headlines, please give this video a like and subscribe to Global Finance Market News. We track how global events translate into market movements every single day. Hit the notification bell so you never miss an update. Everything in this video is for educational and informational purposes only. This is not financial advice, and I am not a financial advisor. Please always do your own research before making any investment decisions. Past performance is never a guarantee of future results. Always consult a qualified financial professional before investing.